Do you know that VWAP and moving averages can be very helpful in a swing trade? If you want to learn how to swing trade using a multiple time frame trend alignment strategy, you definitely have to hang around for this next presentation. Hi, I'm Philip Teo, your host for Trading World Summit, and I'm excited to introduce to you Brian Shannon, our presenter for this session. Brian is the founder and CEO of AlphaTrend.net, a subscription service which is dedicated to swing trading ideas and education. On top of his Chartered Market Technician CMT designation, Brian has accumulated more than 30 years of financial market experience along the way. Brian's work has been featured on CNBC, Halftime Report, Stocks Futures, Options Magazine, CMT Association, MoneyShow.com, and Investopedia. He is also the author of Technical Analysis Using Multiple Timeframes, which is currently available on Amazon. It's a book that actually introduces technical analysis to new traders with the use of market structure and trend alignment. Now, with this short introduction, it's my honor to welcome our summit speaker for this session, Brian Shannon. Hey, Brian, welcome to Trading World Summit.
Hey, Philip, thanks for having me on and doing this. I'm excited. You've got a great lineup here and love your format too. I'm excited about this.
Fantastic. I'm really excited to hear your presentation as well. It's really a privilege to have you on board this summit to share with the summit participants your favorite swing trading strategy with the use of VWAP and moving average. Now, for the benefit of those summit participants who might not know you before this, can you briefly walk us through on your personal trading journey? What were some of the most memorable and interesting aspect of your journey? How did it start for you? And what prompted you to become a specialist in the use of VWAP as a trading tool?
Okay, yeah, that's a lot there, and I can do that pretty quickly for you. I really started trading full-time in 1991 after I graduated college. But prior to that, you know, my interest in the market developed at a young age. I used to sit around on Friday nights with my dad when he would watch Wall Street Week with Louis Rukeyser back in the day. And, you know, I wasn't really interested in the market so much to start out, but it was just hanging out with my dad. And it started, you know, to kind of make sense to me, and I started asking questions, and my father encouraged me, you know, to go with that. So my first stock trade was I was 13 years old. It was a company called LoJack. They did stolen vehicle recovery. I'd seen something on television. The state police in Massachusetts, which at the time it was the car theft capital of the world, but Massachusetts State Police were embracing this technology. So I said to my dad, I said, you know, hey, they have a stock. Can we buy it? I have $500. And the stock was actually $5 per share. And I put up my $500, and my dad gave me leverage. I didn't realize at the time what was going on. He goes, yeah, we'll buy 1,000 shares. So I controlled with my $500, 1,000 shares of this $5 stock. Well, you know, Philip, I got pretty lucky because in about 3 months, it doubled. And, you know, here I am 13 years old, and I controlled 1,000 shares. I just made $5,000 profit at the age of 13. It's probably the worst thing that could have happened, but I was hooked right then and there. I had no idea what leverage is or how that's why, you know, that's why the return was so big, but it kind of just kicked off the obsession. After college, I went to work at a retail brokerage firm and just hated it. I hated everything about it. It was a glorified telemarketing position. People hanging up on you all day when you're bugging them at dinner and trying to get them to buy a stock over the phone. And who buys stock from a 23-year-old kid over the phone anyways? It just doesn't make any sense. But anyways, I like to kid around there. I got to practice with other people's money in the market as a broker. You know, it was nothing, you know, bad about it. It was just it gave me that experience. And I realized that I was more interested in being a trader. So I started a day trading office in Denver, Colorado in 1993. So it was basically a sew shop. And, you know, I worked with a firm out of New York and, you know, managed the office in Denver. And then just kind of, you know, continued to trade and, you know, have that office. And then I created a technical analysis course, which when I look back and look at it, it was in 1994. It was, you know, pretty basic, but actually I was kind of proud of it. So anyways, technical analysis really appealed to me, and shorter term trading. So not necessarily, I started out kind of day trading, and it was a fertile environment at the time. But then I was more attracted to letting things hold for a few days. So swing trading really made a lot of sense to me. It wasn't until maybe 11 years ago, when we were seeing all the HFT stuff going on, where it really messed a lot of people's strategies, including my own, up. But I stuck with it, and I did a lot more day trading back then, just because the signals weren't as clear. And now I'm back to where my real time frame that makes sense to me personally, that is swing trading. So I wrote a book, as you mentioned, 12 years, 2008, about technical analysis using multiple time frames. And here we are today. I'm still doing the same thing. I've got a site called alphatrends.net. People can follow my work on Twitter, is really where, anything I put out, in terms of free content and ideas. Some of those we'll talk about in this presentation. I put those on Twitter, where my handle is @alphatrends. I put my free weekly YouTube video on on Twitter as well. So really, that's the best place for people to kind of see what I'm all about.
I see. You know what? You are one of the definitive expert on the use of VWAP, at least from a retail trader's angle. I mean, looking around at all the different mentors out there. Now, how do you actually got into VWAP, and why did it make such a unique difference to your trading?
Yeah, that's a great question. So, I discovered it kind of by accident in 2003. I certainly didn't invent the volume weighted average price. It's been, since 1988 is when it first became a tool that was used for, an institutional benchmark for pricing trades. But I found it just, kind of screwing around on the charting platform I was using at the time, called Realtick. They had a trend line that I could draw straight across, and as I would draw it straight across, it would bounce kind of up and down, and I didn't realize what it was doing. But anyway, so I found the VWAP for one day and started noticing, hey, this really makes a lot of sense, the way prices move, in relation to it. So I started kind of cobbling together a couple little things on Realtick so I could use multiple day time frames. It wasn't until about 6 years ago that I had TC2000 put the volume weighted average price, the anchored volume weighted average price, in their software. And since then, I've really been kind of the face for, the volume weighted average price. And, now, and they were kind enough to put in there the alpha trend, the anchored VWAP by Alpha Trends. Now we've got, TrendSpider, we've got Trading View, Ninja Trader, Trading, there's a few other, even Yahoo Finance has a free version, but it just makes sense, Philip. It's supply and demand, and that's really what the market is all about. I studied all the other oscillators and indicators, and this one just makes sense, and hopefully I can talk a little bit about that and make the case for that to the audience here today.
Fantastic, wonderful. I'm really excited right now. So I'm sure you are all ready as well to share your presentation with use of VWAP moving average and your swing trading strategy with the summit participants. Now, to the summit participants watching this video right now, I'm sure you're just as eager as me to seek Brian's insight. So without further ado, let's sit back and learn from Brian.
Hey, Philip, thanks, and welcome, everybody. Let's get started. Let's just jump right in here. What I want to talk about today is my favorite swing trade strategy, and it's simply using multiple time frames, price, volume weighted average price, a couple moving averages, and really that's it. It's about keeping it simple. Let me whet your appetite. Now, 3 days ago, I put this on Twitter. Here's a picture of that tweet. And this is a swing trade setup that I had put on. And you can see that this is Casper. It's a mattress company, CSPR. And I said it's a friendly chart simply because Casper the Friendly Ghost, I was making lame joke there, dad joke, I guess you would call it. Anyways, you can see here, no setup is complete without a stop. So I said, here's the idea, but a stop under yesterday's low if it takes out Wednesday's high. So this was Wednesday's high, and that was yesterday's low. So what I'm doing on every single trade and every single tweet, I try to put a stop in there, because risk management, and we're going to talk about that a lot, really is job number one. Well, here's what happened. This is today. Today is Tuesday. That chart was on a Friday, and we've got a great environment. They don't all work like this, I promise. I wish they did, but they don't. So the stock is up, and it closed at $11.84. You can see it got above that high from Wednesday right there. It never violated the low that I was talking about. So here's a perfect, this is the type of swing trade opportunity we're looking for. What you didn't see on Twitter was the other work that went behind the scenes. It wasn't simply just pulling up one chart and saying, hey, I like the way that looks. I'll buy it above this high with a stop below that low. What I'm doing is truly looking at multiple time frames. I was aware of the weekly chart. Now, this company hasn't been public very long, just over a year. But on the daily time frame, you can see here that this is where the stock came public. And that was, I guess, probably about February of 2020. And, it was a terrible IPO right from the start. It opened, I think they priced it at $10 or $11 per share. And then the sellers came in and just crushed it. So if you bought this one from the beginning, you were hurting pretty bad. Saw a lot of volatility, and what we see on this daily chart, so on the left here, each one of these candles represents one day. They're a little squished up so they don't look like candles, but they actually are. I wanted to fit it both on the same screen. So on here I have two simple moving averages. This light blue one is a rising 20-day moving average, and you can see when I outline it to show it a little bit better how how the stock has respected that 20-day moving average on these two recent pullbacks. So let me go in and erase some of this stuff and just kind of clean it up so we can see. Now, a couple other things that made my decision to buy this stock. Well, it was a nice, tight little consolidation. It was up on big volume, light volume as it consolidated. That's just classic consolidation that shows it's correcting more through time rather than a deeper price pullback. And it was sitting under this bigger band of resistance. So we had seen this drive higher, which was earnings related. Again, on big volume, followed by lighter volume, another push higher. So what we're seeing on the right is actually a detail basically of this portion of the chart right in here. So we're taking these daily bars, which there's about 15 of them, and we're looking at them under the magnifying glass. So we have 30-minute candles. So each day the market's open 390 minutes. So there's 13 of these 30-minute candles for each day. So the Wednesday high was this high right here. This is what I was talking about. And you can see where it took that out was the purchase price at just about $10 per share. Now, the key was, as I mentioned, that the low of the previous couple days was where the initial protective stop went. If this stock didn't go, if it instead did something like this, well, then I would have been stopped out, taken my loss, and moved on. But the thing I liked about this was that also tested the 5-day moving average. Now, we'll talk more about the 5-day moving average and how to calculate it on an intraday chart in a few slides here. But that's one of my key things I look for in a swing trade is I want to see the stock make a higher high if prices are above a flat to advancing, and you can see the 5-day moving average was advancing. So as it makes a higher high above the flat to advancing 5-day moving average, that's my signal to buy with a stop under here. As the stock rises up, you can see that this prior resistance was tested. It held as support. It rallied up, and guess what I did? I raised my stop to right here, basically break even. I don't like losing money. Risk management is a religion for me. It truly is. A lot of people talk about risk management as it's a nebulous concept. To me, it's how I've been in this business as long as I have and had the success that I have. Now, it rallied up. I sold a third of it into this first strength simply to reduce my risk. I'm always trying to reduce risk. My target is higher. Now, I think, the way this market's kind of crazy. Maybe it could go on to a new high. I'm not expecting that, but I'm open to the possibility of it. So I take my first third off. I have my stop down here. If I get stopped out on 2/3, I still make money. It's basically risk-free, theoretically, because maybe the stock gaps down to $8 per share. Theoretically, I've taken the risk out. Now, today, we saw it just ramped really nicely higher here today. So I'm going to raise my stop up, and as it, kind of does something like this, I'll put my stop underneath successive higher lows. As it breaks, this level, I'll raise my stop underneath that. I want to use my stops. Not, sometimes you see, hey, 5% stops, 7% stops, 10% stops. Those are just random percentages that mean nothing, really. What I want to do is use the definition of trend. The definition of trend, an uptrend, is higher highs and higher lows. So again, if I buy the stock over here as it's making this higher high, this is where it tells me this is my cue to get involved, because it is the higher high. I'm sorry, right here. So this is the higher high. Where does my stop go? Underneath the most recent relevant higher low. That's right here. I raised it under here. I raised it under here, and this is where I have some of my stop. But the point is, I want to listen to the definition of trend. I'm in this for a trend trade. I might get stopped out tomorrow. I might get stopped out in 8 days. I might get stopped out at $10 per share or 16. I have no idea. It's in the market's hands. I have to trust my process. I have to trust the trend and say, now it's up to the market. So now that I've whetted your appetite with a recent example of something that worked well, let's get down into what we're really here to talk about and some real education that I want to give you today. So we're going to cover 4 things. 1, market structure, and that goes back again to my book, Technical Analysis Using Multiple Time Frames, subtitled How to Profit from Trend Alignment. I sometimes forget, it's a heck of a mouthful. So we'll talk about market structure. Then we're going to talk about the time frames, and again, my time frame is swing trading. We'll define that. We'll talk about the tools I use. You've seen them briefly. A 20-day moving average, a 50-day moving average on a daily chart, a 5-day moving average on a shorter term time frame, volume weighted average price levels, and then we'll talk about the strategy of trend alignment and what does that actually mean and how do we utilize it, and then most importantly, risk management. So first subject is market structure. Here's a dumbed down version of something you're going to see in a moment. And this was made famous by Stan Weinstein, the 4 stages, which I'm sure a lot of you are familiar with. Stage 1, accumulation, occurs after a prior decline. Now there's a phrase that says if they don't scare you out on the way down, they tend to wear you out. The crazy thing about this market is just now, here we are in June of 2021, that we've seen a lot of these growth stocks get cut in half, down 60, 70%. And normally they would experience a long stage 1 accumulation. Instead, what we're seeing is they're going back up like this. It just doesn't it's not normal. So a lot of people are getting bailed out of mistakes. Hopefully, you're using this opportunity to get bailed out of your mistakes and not ride them down again. What we want to do is we want to be involved in stage 2 uptrend for stocks that are moving higher. As it starts to turn sideways, not so interested. It's boring. It's not doing anything. And we don't know if it doesn't just go 1, 2, 3, 4 every single time. But as it breaks the lows of stage 3, we say, okay, now we're in stage 4. We just saw Bitcoin do that recently, and Bitcoin continues to be in a downtrend. We're getting some bounces in Bitcoin, but we don't know where the bottom is yet. Again, if they don't scare you out, they'll often wear you out, except in the market of 2021. it can go like this. It's the craziest thing. So again, don't confuse brains for a bull market. We've got a great bull market. Don't let these sloppy habits make you think you can get away with this all the time. We use this type of structure so we can avoid this, what you see on the screen right here. This is the way brand new traders and investors get involved in the market. We don't have to go through all of these. I'm sure you've seen something similar to it before. But, excitement peaks near the tops, and as we're down near the lows and people aren't interested anymore, stocks start moving higher again. Nobody wants to believe it, but they all get excited up in here. So what we want to do is we want to find the magical balance. And that's why looking at price action and letting the message of the market dictate to us what we should be doing is in my mind the best way of looking at the market. So I kind of took that diagram, and by the way, at the end, you'll see there's a sign. You can send an email to 1B Shannon, numeral 1B SHANNON at Gmail and get these slides. I'll also send you a color copy of this market structure poster that you can print out. Anyway, because you can see there's a lot of information in there. This kind of just tells you what the stages are, but then we break it down to sub-stages because we know this stage 2 doesn't just go straight up. Instead, we look at this little subsection and say, those patterns repeat over and over again. So we want to buy, for instance, right here. We don't want to buy pullbacks. I can't stand it when people say buy the dip. I don't know if this is a dip or if this is the decline. I want to buy after the dip has exhausted and the buyers regain control and there's upward momentum and I can set my stop in a logical place. That's the professional way of swing trading. That's the professional way of getting into the market, not trying to buy the bottom or sell the top, but getting that nice meat in between. So what we want to do during stage 1 is we want to start to anticipate. And by the way, these 4 stages occur on every single time frame. As you saw with a 30-minute time frame of Casper, we saw those 4 stages there as well, and we'll make more examples of that as we go along. But the stage 1 accumulation, that's where we're either going to avoid it, or if it's, if the primary trend is higher, we're going to start to say, hey, let's start to make notice. Let's start to set alerts for something to happen. I don't have to watch the stock like a hawk, and I don't want to buy it well, it's just going sideways, but I want to be alert if things are starting to happen. So maybe I watch that, I look at that stock during my daily routine of looking through hundreds of stocks, at the end of the day. Or maybe I just set an alert. I set the alert and it pops up on my radar. Doesn't mean I'm going to buy it, but it says take an interest because maybe it's about to enter a stage 2 markup. And if it's in that, well, we want to participate on the long side, and we certainly don't want to short it. How many times have you seen a stock that's up too much because it's a bad company or something, and you just watch it go higher and you try to sell it short? Look at what happened with GameStop or AMC. I don't think there's a lot of people that will argue that they're fundamentally great companies, but that doesn't mean, they've run over some of the biggest so-called smartest money on the planet that we're short these things. It can happen on all time frames to all participants. Smart money can be you. Smart money doesn't mean the guy with a $5 billion fund. They do a lot of stupid stuff too, trust me. We all do, but if we can minimize the stupid mistakes like selling short in an uptrend or buying stocks on the way down, you're going to be way ahead, and you're going to have that mental balance that allows you to look at the market more objectively and disciplined and trade it on your terms. Again, avoiding all that nonsense that we saw on that chart with all the different emotions. So in stage 1, basically, we want to anticipate price maybe getting ready. And if it does break into stage 2, we participate. And if it starts to go sideways in stage 3, we're going to exit our long, and maybe we're going to anticipate going short, or just avoid it. And so we would anticipate a short, and then we would participate as it starts to decline, and we would avoid long. What I didn't say on here is most important. After you buy or after you sell short, your job isn't over. Your job just has just begun. Your job is now to manage risk. I will say that. I'm going to try to say it at least 30 more times in the next half hour. I bet you I can do it. So here again, just real simplified with a couple moving averages. Just look at what makes sense. Pullbacks to rising moving averages tend to act as support. When the moving averages start to crisscross, it's saying indecision. The short-term trend crossed below the intermediate term. So we have indecision. It breaks down and makes lower highs and lower lows. Stage 4. It starts to turn sideways. Moving averages cross over again. We get back above the previous stage 1 high. Now we look at this as innocent till proven guilty. It doesn't mean we are going to make money on every single trade. In fact, I would tell you that if I had purchased it right here, my stop would have been under here, and I probably would have been out of this for a swing trade. If it had instead done this, I would have been looking to raise my stop underneath these successive higher lows. Maybe at this point, I would have put my stop here. At this point, I would have raised it to there. Our job, again, is to manage risk. That's your most important job, manage risk. See, I just knocked out 2 of those 25 I said I would do. So let's talk about the next section, which is talking about time frame and the tools we use for swing trading. Swing trading, again, is what makes sense to me personally. It's not too active that I'm glued to every little tick and micromanaging and second guessing everything that happens in the market, like often would happen to me when I would sit down and attempt to be a day trader exclusively. I still do some day trades when the opportunity presents themselves to me, but I much prefer to hold a stock for 3-4 days and let the stock do the work rather than me sitting there grinding it out. Anyways, swing trading, again, you've got to figure out if it makes sense for you. To me, it's what makes sense. Swing trading is anywhere from if it doesn't work right away, well, then generally it's a day trade. If I buy the stock, let's say Casper at $10, it drops right down through my stop of $9.60 immediately. The market told me I was wrong. I'm not going to argue. I'm not going to try to fight it and say, well, I wanted to hold this for a swing trade, so I'm not a day trader. That's ridiculous. Manage risk. That's your job. If you get stopped out, well, it's a day trade. You know what? That happens. However, if it continues to go in my direction, I'm not here to say I hold stocks for 4 days and then I sell them. Maybe I can hold this thing for 3 weeks and who knows, maybe it doubles. Look at what these stocks are doing. We're in an amazing market environment right now, and there's just gobs and piles of money all over the place to be picked up. This could be the next one. I don't know. None of us knows. So we give the benefit of the doubt to the market structure, and we say, as long as it continues to make higher highs and higher lows, maybe I'll peel little pieces off along the way, just because sometimes it gets so ridiculous. You think it can't go up any higher than this, but I'll sell a little bit. And that's something that it took me a long time in my career to learn, is always hold on to some and make sure you honor that stop, because it might look like it's way too much up at 20% and 30% and 40%. But when you get stopped out with 120% gain on that final third, trust me, it's a huge difference between just listening to your emotions. So the goal is to be in the stocks that are moving and avoid the ones that are just stagnant. We're trying to leverage our time, basically. Stocks do one of 3 things. Accumulation and distribution means they're going sideways. Stage 2, uptrend, they're going higher. Stage 4, they're in a decline. Keep it simple. Leonardo da Vinci knew that eons ago. Every market session is either going to be a breakout, and what we'll talk about is, breakouts a lot of times are often late. You might say, well, breakouts don't work anymore. There's a fix for that, trust me, because you're most likely chasing a stock that's already moved past an inflection point. So what we want to look at in the focus of swing trading is simply a continuation. It's a continuation of the trend on the higher time frame. We're using shorter term time frames to time our entry into it, but it's a continuation, or it's a reversal, and that's why we use stops. Reversals can come up for no reason out of nowhere. You can do all of the research in the world, and you can be, again, not to make too much about it, but look at a couple of the examples in the last 6 months. Bill Hwang, who got over leveraged and lost $4 billion in the matter of 3 nights, getting blown up for being over leveraged and over concentrated in some stocks. Or what happened to Plotkin and GME. They lost billions by being stubborn and fighting the trend and thinking, hey, well, these little clowns on Wall Street bets or whatever, I can beat them. This stock's garbage, it's going back down. Listen to the message of the market and cut losers. Risk management, remember? So in swing trading, it's a couple days to a couple weeks. We're trying to make, a multiple of what we see as our risk. We're trying, this here, I can tell you that this stock right now at this point is in a downtrend. These swing highs, we have this high, and we have a lower high. So here we see, here's a stage 4 decline, and then we see the trend break. You should be stopped out. Maybe you go long. I tend to look at the primary trend and say, if the primary trend was lower, I want my trends aligned with that bigger time frame. So I'm going to be shorting here, or I'm going to be shorting here underneath that higher low. But, there's a lot of different ways to even swing trade. You've got to figure out where it fits in for you. There's no perfect way for everyone. What we generally want to do is say, all right, I think that if I'm shorting here, I expect it to at least visit that prior low. And here's where my stop should go, above that high, or maybe above this high right here, more likely. That way, is my risk 1 part risk for the potential of 3 parts reward? Well, we did even better than that. And here, if I sell short as it makes this lower low, we have this high and we have this high. This high is lower than that high. We short at the lower low, definition of trend, and set our stop above this level. So now if it does this, we're stopped out. Or if it does another decline, that's up to the market to tell us. So, risk management, again, there's a couple things that go with risk management. Trade in the direction of the primary trend. Don't put all your eggs in one basket, or if you do, watch that basket really carefully, as Mark Twain said. But there's no assurance something isn't going to come out of the blue, that 100-year storm that happens every 5 years. So, these are numbers that people talk about, 10 to 20%. Hey, you know what? Sometimes people will do the YOLO trade and put 80%. I don't think that's smart, but, find the balance for you. I'm not here to preach about what you should do with your money. I'm here to tell you about my 30 years of full-time experience trading and what works well for me. I've seen bull markets and bear markets, all kinds of cycles. I've been through them all. This might be the craziest on the upside. I really think it beats '08. But what we want to look at as a just most basic tool is something for trend reference, which is a moving average. I like to say each time frame you should have at least one moving average, and that's what I call the dominant moving average for that time frame. We want to look at it, just simply say, what's the primary trend here? Are we in an uptrend? Are we in a downtrend? Where do the buyers take control? Where do they lose control? What's the path of least resistance? So we want to trade in the direction of the primary trend, but we don't want to be chasing things. So, how far above or below that dominant moving average makes a huge difference. So we'll get more into the nitty gritty of that. But actually, I contemplated taking this out because I'm not a counter trend trader, but if you are a counter trend trader, we should be working on the next time frame lower, that you're not really looking at that, dominant time frame. So when we look at a moving average, it simply provides some reference points. Here's a daily chart of a stock in an uptrend, and then here's what it is, without moving averages. Here's the moving averages by themselves. We can look at the moving averages, and here's a 50-day moving average. That tells me the dominant trend is higher. And when we combine the price with the moving averages, you can start to see that, these moving averages, it smooths out the price action, gives us a time-based constant to compare price action to. So when we look at those 50-day moving averages, a lot of people just are happy with the fact that, people say, well, the 50-day moving average tends to act as support. So they just nod their heads and say, okay, that's great, but why? Why does it tend to act as support? Why does it tend to act as resistance? If you think about the institution that's long a bunch of this stock and it pulls back to the 50-day moving average, as the stock rallied up, they might have, if they had 10 million shares, they might have sold 1 million shares on the way up in here because they're selling when they can. And as it pulls back, they're saying, okay, well, let's stick a bid in there because we have 9 million shares. Let's bid for 300,000 shares, and that will create support there. So they're saying no longer are we selling down to that 9 million, but instead we've removed our supply and now we're creating demand in there. Well, then all the people who are taught that the 50-day moving average tends to act as support, what do? They say, I'll stick a bid in there because that's support. Again, now we have a new source of demand. For the people who were shorting up here and saying, well, I'll cover at the 50-day moving average, there's less supply because they're not shorting anymore. There's more demand because they're covering. And it tends to be this self-fulfilling prophecy until it fails. And then it becomes resistance and then support over and over again. So think more about the psychology of it rather than just saying, hey, it's the 50-day moving average, I'm going to buy it. Why are you buying it? That's kind of just, taking blind faith. And to me, you don't want to have blind faith in the market. You want confirmation. You look at that 50-day moving average and anticipate that buyers might show up, and you wait for confirmation before they do. So for me, the moving averages that I focus on for swing trading on a daily time frame, I look at what I consider the intermediate and long-term trends, which are represented by a 20 and a 50-day moving average. So the average of the last 20 days, the average of the last 50 days. And you'll see that oftentimes they act as support and resistance. For an intermediate term time frame, and that's where we're talking about a 65 or 30-minute time frame. And what I look at there, and that might confuse you. So let me just explain that really quickly. Because a lot of people use an hourly chart. I don't use hourly charts, and here's why. There's 390 minutes in a day. If you divide that by 60 minutes in an hour, you get 6.5. What that means is there aren't seven, there's 7 candles, 7 hours that you look at on an hourly chart that represent one day, but one of those candles only represents 30 minutes. 6 of them represent 60 minutes. So in order to adjust for that, 390 divided by 65 is 6. If we have 6 equal periods, we're not giving extra weight. We'd be giving twice as much weight to that first 30-minute period than we did the rest of the 6 hours in the day. And there's no reason to do that. It's not more important. We want to treat them equally. So we either have 6 65-minute candles in a day or 13 30-minute candles in a day. So there I use a 5-day moving average, and we'll talk about how to do that. And then on shorter term time frames, and even on that time frame and all of time frames, I look at a volume weighted average price. These will be different for whether you're an investor or swing trader or day trader. People always ask me the question, well, Brian, do you look at simple or exponential? And my answer is really this. It's irrelevant. It doesn't matter. I'm not looking to buy at the 20-day moving average or the 20-day exponential moving average. I'm looking at them as a reference point to compare price to. It pulls back on late volume to a rising 20-day moving average. Guess what? The 20 exponential and simple are going to be within a few cents of each other. I'm not looking to buy on that moving average. I'm looking at it as a reference point to say, now drill down to a shorter term time frame and see if it actually makes sense to buy or sell and start to anticipate in that area. Don't just blindly participate, anticipate, switch to a shorter term time frame and see if it makes sense. I'm not going to go over the math here because it doesn't, it really doesn't matter of, simple and exponential and how they are created. I do use simple because most people do, and I'm a simple person, and I want to know what most people are looking at. Most people aren't looking at the phase of the moon, so it doesn't get much weight in my decision-making process, and it shouldn't, in most people's decision-making process, unless you're some kind of, super astronomer, astrologer type guy or female. The point is, when we trade long, we want to see at a minimum a rising 50-day moving average. When we see that happen, we look at these consolidations. They're up on big volume. They consolidate on light volume. And then that tells us drill down to a shorter term time frame. The 5-day moving average flattens out and turns higher. I want to buy the higher high. I don't want to buy the breakout. I don't want to buy the breakout on the daily time frame. I want to buy right here. I want to buy ahead of the breakout buyers. Maybe I'm going to sell some into this strength if it starts to flatten out. But if it's above the 5-day moving average and it's making higher highs and higher lows, my job is to say it with me, manage risk. Correct. So that's our job. On a short, it's just the opposite. We see a stock in a downtrend. Maybe it found resistance at the 50-day moving average. And then we would look inside and short it in here. This one, it rallied up to the 50-day moving average. The 50-day moving average, you can see it's the 50-day moving average is declining. To me, it's more important is the direction of the 50-day moving average, not whether it closes above or below. If the 50-day moving average is declining, I look at it and say it's guilty till proven innocent. Let's look at this action on a shorter time frame. So we look at it in there. The 5-day moving average flattens out and starts to turn lower. We're anticipating in this zone, and we participate with our short here. After we participate, what is our job? I think I've got maybe like 19 left. Manage risk. We manage risk. So what do? We set our stop above this high, above this high. Which one makes most sense to you? Sometimes I'll put half of my stop here and half of my stop there. There's nothing wrong with staggering. There are no commissions. It doesn't matter. It's not always going to cost you anything. So we participate and we let the market take care of it. And we lower our stops as it makes successive lower highs and lower lows. So for me, the dominant moving average on any given time frame, when you're looking at data of at least 200 days, a year or more, you want to look at the 200-day moving average just to see that macro picture. And then on the daily, I generally look at about a year worth of data. I'll look at the 50-day. Which is equal to the 10-week on the weekly time frame. So 5 days in a week, and over the course of 10 weeks, there's 50 days. You'll see that it's not always the same because if you do it on a Monday, you're looking at 9 weeks plus 1 day. So you're looking at 9 times 5, 45. You're only looking at a 46-day moving average. Maybe one of those days was a half day. Maybe one of those days was a holiday. It's going to be close enough, but it's kind of going back to the same type of math we did with the 5-day moving average. And the 5-day moving average we look at on shorter term time frames and the volume weighted average price. So the question is, how do we look at a 5-day moving average when we're looking at shorter term time frames? And the answer is in the math. Now, this is Tesla just recently, and this was, I think, through June 1st. So Tesla was below a declining 5-day moving average. To me, when I see these rallies, I look at it and say it's guilty till proven innocent. As long as that 5-day moving average is declining, yes, you can make money on these bounces, but they're more likely to fail. But as the 5-day moving average flattens out and then it breaks resistance, well, then now we've got a different beast. Now we've got a stock where the buyers are in control. You don't have to buy this low, because if you bought this low, you probably tried to buy this low and this low and this low, and now your average is somewhere up in here versus buying right here and not going through all that stress. So again, there's 390 minutes in a day. Over the course of 5 days, 39 times 5 means there's 1,950 minutes of trading in 5 days. So we want to keep a constant. As we mentioned, if we're looking at 65-minute candles, there are, how many did we say in one day? There are 6 65-minute candles. 6 times 65 is 390. Multiply that times 5. 6 times 5, we have 30. So a 30-period moving average on a 65-minute time frame is your 5 days, 5 full days. On this 30-minute chart we have here, this 5-day moving average is represented by 65-period moving average, because 30-minute period times 65 of those periods is 1,950 minutes. That's terrible writing, but that's 5 days. So you can do that math on any time frame. A 10-minute time frame, well, you would look at 195 periods, because 10 times 195 is just what it says, 1,950. So the way I look at it, and this is really an important slide. I will say it's maybe one of the most important slides on here today, because to me, if the stock has a declining 5-day moving average, I simply will not buy it. I will not buy that stock. As it pokes its head above it, I'm not going to buy it. I look at it and say it's guilty till proven innocent. I want to see that the sellers are exhausted. It starts, and look at what we're looking at. This is from April to June. We've got, what is that, 10 weeks? Well, what is this? This is a stage 4 decline. And what is this? This is a stage 1 accumulation. And what is this? That's a breakout into a stage 2 uptrend. Is it going to continue to do that, or is it going to do this? And, maybe come back up to that 5-day moving average like that. This, again, is my most important indicator to tell me whether or not it makes sense to buy a stock to initiate a new swing trade, long or short. I will short, breakdowns in a stock like this if it makes sense with the other things that I look at. It's not just one thing. It never is. People always say, well, what 2 time frames should I use? I use a 65-minute time frame. I look at the 30-minute. I look at the weekly. Sometimes I look at the monthly time frame. It's a matter of getting the most complete picture, most objective and complete picture possible by looking at all the data possible. So the volume weighted average price is kind of what it sounds like. It's the average price weighted by the amount of volume that traded there. It's the mathematical average from any point in time. And I consider it the most perfect indicator, because it does the best job of telling us who's in control, buyers or sellers, from any point in time. There's 3 components. Price. If you know me, you know that I always say only price pays. Price is how we keep score. It tells us whether we're winning or losing. There's no attaboys. You're either making money or losing money. Volume shows us the emotional commitment to a stock, but volume can often be late. If you're waiting for volume to confirm price movement, you're going to find sometimes you're chasing a stock. Volume tends to peak at turning points and diminish on pullbacks. We want to see advancing volume on the rally. As it peaks out, you typically see the highest volume. And then on the pullbacks, you'll see lighter volume as it pulls back if it's a healthy pullback. It tells us the emotional commitment. Time is a relative study. For me, my chosen time frame is swing trading. So my best indicator, again, of the trend on that intermediate term time frame is looking at the 5-day moving average. So the way to look at a volume weighted average price is simply just think of it as a dollar cost average. We all know at least what dollar cost average is, or at least I hope you do. It's simply saying, hey, I like Apple. I'm going to take $1,000 on the 15th of each month. I'm just going to buy $1,000 worth of stock. Well, if you did that during the time period I put this slide together, the stock Apple was $199. So your first purchase, you purchased $1,000 worth at $199.23. That got you 5.02 shares. Well, the stock dropped the next month and you bought 4 shares. Your average between those was 195.08. That's your volume weighted average price. This month, the next month, it rallied back up a little bit. You bought 5.16. So you're buying more shares at lower prices. And as the stock is at 232, that $1,000 only gets you 4.25 shares. So you've made 1, 2, 3, 4, 5, 6, 7 purchases, and your average price is this. That's your dollar cost average. That's the volume weighted average price. We're weighting it for the number of shares that you purchased. It's the same thing for, starting out with a volume weighted average price for the day. It starts with the first minute, then it averages the first and second minutes in the volume, the third minute, and on throughout the day. But very similar to any moving average. If it's trending higher, it will often act as support. It tends to. Don't look at it as an absolute that it will be support. It tends to act as support. So when you see pullbacks to that volume weighted average price, it should get your attention and say, now I'm going to look to a shorter term time frame and see if there's actual buying here. And if there is starting to be buying, well, then you can decide whether or not to participate. And then what do? I think we're down to 17 left. We manage risk. We say, okay, I'm going to participate because it's moving away from here, but I'm going to set my stop underneath that higher low on the time frame you're engaged, because that's my job, is to manage risk. So be aware of the direction. And just as I pointed out on that Tesla chart, we saw that it rallied up through the declining 5-day moving average, and that sometimes gets people excited. Don't fall for it. It's, that's sucker bait. You're being a sucker most of the time. Not every time. Sometimes it'll continue to go, but put the odds in your favor. That's what trading is all about, is trying to have the odds in your favor right from the start so that you can start making money when the stock moves instead of trying to get back to even. How many times do you try to get back to even? So the way I look at the volume weighted average price, again, it tends to act as support in an uptrend. This is the same stock, and I just simply took a volume weighted average price from this low and I anchored it there, meaning I set the study to start from there because that was an important low point. And you can see from that low point, the buyers had defended it. It tends to act as support. So demand was greater than supply, so the stock was going up. Well, as it pulled back over here, at this point, you say, wait a minute, that must be an important high. So I'm going to anchor a VWAP there. So that's what we did. We put this red one on, and you can see that the sellers were defending that level. So when we combine them together, here's that uptrend. The buyers were in control here. The sellers took control right here. And now, where are we? We're in the middle of no man's land. So we look at that and say, well, the primary trend is higher. So if it can break this peak, make a higher high, and get above that, that's where what this represents is the average participant from this point, the average person who went long during all this pullback, their average price is right here. The average short, people who are shorting in here, their average short is right here. So that tells me that becomes this kind of fulcrum point where we can tip the scales back. I don't know which way it's going to go, but the primary trend is higher. So it's most likely that it's going to continue to move higher. So what I want to do is I want to start to anticipate. I want to look at shorter term time frames. I want to see if something like this happens. And then I want to buy that break higher. And I'm going to set my stop underneath one of these higher lows and just repeat that process. It's not about just trying to guess, hey, it's a good stock. It's, here was Apple on a 65-minute time frame. We had an important low. And this is one I had put on Twitter in January of this year. I put it on right in here saying, here's what I think is going to happen. This was an actual tweet that, the buyers are in control. They're defending this level. The primary trend, if you looked at the bigger time frame, was higher. At this point, as it started pulling back, I put a VWAP on that and said, what's the average price look like? Well, what did we see happen? It got back above that volume weighted average price. and the buyers regain control. Wait for price confirmation. Wait for the buyers to be in control. CRSR was a monster IPO last year. I had been looking at this one, early on, and as it was just, this is where it had come public, and this is about 20 days into its life as as a company. As it got back above here, I bought the stock, and that was right. It had actually gapped up. So what I did was looked at a shorter term time frame and got involved here. And I'll show you an example of one I did today in VMware by using a 1 minute time frame, believe it or not, to really drill down to make sure I could get involved. This stock went on to go up 200-300% or so. Here's one that didn't work. They don't all work. So, there's Coursera came public. The buyers looked like they were defending it. At this point, we can say, let's draw a VWAP off of that peak because it made a lower high and lower low. Well, I'm not just going to blindly buy there. Instead, I'm going to look for something like this to happen. And then I want to be a buyer here with a stop either under this low, or maybe half of my stop here, half of my stop there. Instead, the stock broke down. And guess what? I didn't buy it. Why would I buy it? I don't care about this stock. I don't care about this company. I'd like for them to do well. I hope they're a good company or whatever. I'm a trader. My job isn't to analyze the company and give out employee ribbons for running a good company. My job is to anticipate, wait for price confirmation, participate, and then manage risk. So, trend alignment. Dow theory is the premise of technical analysis, and Charles Dow, in the Dow theory, basically said there's three types of movements in the market. The primary trends, he compared them to oceans; secondary, which are like waves; and then the tertiary, the short-term trends, they're insignificant ripples. So, and that was back in the day. We didn't have, computers to chart and all that things. So, now we look at it, and here's a weekly, a daily, and a 30-minute time frame. People will say, what's the trend? Well, the trend of this stock is clearly higher. But if you bought it at $130 per share, you're saying, hey, wait a minute, this stock's in a horrible downtrend. I just lost 6 points in the last 4 days. One of the questions are you bullish or bearish? For what time frame? On this time frame, sure, it's in an uptrend. But guess what? It's pulling back. I'm not going to be the dope that buys this stuff as it's pulling back. I want to wait for price confirmation. I want to see the buyers are able to regain control. I'm not going to blindly buy at a 20-day, a 50-day moving average. A 61.8% retracement isn't going to get me to buy. If a 61.8% retracement lines up with the 50-day moving average, and we have the volume weighted average price from the prior low, it's going to tell me I should start looking closely and getting involved and looking at these. So when it comes to looking at them on charts, we want to start with a daily time frame and say, at a minimum, this is again for swing trades, we're going to look at a minimum of a daily time frame to say, what's the primary trend? I want to be aligned with that. I don't want to fight the trend, so I'll look at a daily time frame and the 50-day moving average. If the 50-day moving average is up, it's probably a candidate for a purchase. If it's down, it's a candidate for short. Doesn't mean it's a short, it's a candidate to explore. What I will do then is look at a shorter term time frame. That could be, and we didn't talk about this one, but 130 minutes. How many of those candles are there per day? There's 390 minutes in a day. If you divide that by 130, you get 3 equal candles. 6 of these or 13 of these. That's an important point. So don't look at 2-hour charts. Look at 130-minute charts, because 2-hour charts, it doesn't make sense. That 2-hour charts is 120 times 3 is 360. You've still got a half hour missing in your day. So you're going to have one 30-minute candle and 2 120-minute candles. Don't do it. Anyways, we're going to look at that to say, does it make sense? Where is the potential support and resistance? Can I justify a potential risk-reward scenario and then drill down to a shorter term time frame There should be a slash there, a 15-minute, a 10-minute, maybe a 5-minute time frame to really fine-tune my entry. So again, we want to anticipate all the potential scenarios, including where our stop goes. What happens if I'm wrong? We're just sitting on our surfboard waiting for the wave to come in. The wave starts to build. We're anticipating. The wave starts. We paddle in. We hop on the wave, and we participate. Doesn't mean we just stand there on our board. It means we move with the wave. We move back and forth. We listen to the ocean. What's it saying? It's saying, hey, the wave wants to take you here, but there's a rock over there. Avoid that. Don't get stopped out. Continue to avoid it. Manage risk. It's our job, number one. I think I've got about 13 of those left. Trend alignment, again, multiple time frames to say, here's a pullback to a rising 50-day moving average. I'm going to anticipate that this will continue because the stock, if we look at it, is showing higher highs and higher lows. And this is a pullback to the 50-day moving average. I'm not going to buy there because look at what happened. You wasted 2 weeks sitting there waiting for something to happen. Instead, you say, I'm going to look at it on a shorter term time frame. And as it gets back above and makes a higher high above a flat to rising 5-day moving average, now the buyers are in control. And that's what we're seeing. We're not seeing on this time frame. So we want to get involved and we exit as it makes a lower low. It's trend alignment. When the primary trend is in a stage 2 uptrend, we look at it and we avoid this stage 4 pullback. We anticipate during stage 1. It makes this higher high. We don't know that it's going to do this, but that's what they're supposed to do if the trend is valid. So we participate there and we set our stop, and as it tests that prior resistance is tested and it starts to move higher, we raise our stop. And then as it rallies again and it breaks that level, we raise our stop again to whatever makes most sense for you personally. This is the stuff I do all day, every day at Alpha Trends. So we look at it and we say, what's our risk reward? Before you get involved in any stock, ask yourself, the biggest mistake I see people doing is getting excited about a stock that's already had this huge run. I get questions all the time. Hey, Brian, what do you think about CSPR? It broke out past 11 today. I know, we bought it at 10 2 days ago. Don't chase the stock. You should be in the mode of protecting your profits. Don't chase. You want to look at it and say, where has it come from? It just ran 10% in 3 days. Is that a good place to buy? I'm not going to encourage anyone to do it. I hope they continue to because I'm long, and I hope they buy it up 20, 30, 40%. But the risk reward doesn't make sense. Where does it have the potential to go? The prior high was 15. Maybe it can make it there. Is there enough potential profit based on what I perceive the risk and reward to be? And it's all perception. If you're not good at reading charts, you're going to come up with these risk rewards and say, hey, wow, I can risk 5 cents to make $100. I see people doing that. And no, that's not how it works, dude. You've got to understand really how it works. So we anticipate this. Before the market opened this morning, I put this on Twitter. I said, I don't have a position yet. And this is, it's 6:15 a.m. That's my time, local. I'm in Colorado. So that's an hour and 15 minutes before the market opens. I've got an eye on it. And you can see here, I referenced the weekly chart. What do we see on the weekly time frame? Here we've got this longer term resistance, and this represents about a year and a half. That resistance was broken, and then I drilled down and said, here's the break of the resistance. And look at how that resistance, I put, resistance is a red line and green, it's been holding support. Well, in there you also see a rising 50-day moving average. The 20-day moving average looks like this. So I looked at it and said, it just had earnings, it's absorbed those. Let's see if it can do something. Here's how I handled that. Here's a 65-minute chart. Here's the volume weighted average price off of the peak. And this is the peak I'm talking about right here in the daily time frame, which was about a month and a half ago. So that was obviously an important high. The volume weighted average price was declining, 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 declining. And then what? It starts to flatten out. That means we have kind of an equilibrium now. We had some shakeouts in here, and now We saw that it broke the trend line on the open today. And what happened? Well, yesterday it closed right here. Today it gapped up. And it gapped up, so let's just say, what was this about? I don't remember, 161 to maybe 161.80. I didn't buy the gap. Instead, I put this is a 1 minute chart over here. As it broke back above the flat to rising volume weighted average price, I bought there. And my initial stop was actually right here, just under the gap, under the low prior to, I'm sorry, I bought it right here and put my stop there. I didn't want to put my stop way down here. So now I've taken a third off. I think I took a third off somewhere over in here, and I'm letting that one continue to go. Now I've taken some risk off. My stop is basically break even on the balance. Let's see what happens. I don't know, but I'm hoping it can do something like this and go on to $200 per share or $220 or whatever this high was 3-4 years ago. We don't know what's going to happen, but we have a stop on every trade. Here's one that I put on Twitter May 28th, so about 2 weeks ago. Nice looking chart. Here you can see this green is the rising 20-day moving average. We saw the stock up on big volume. It consolidated in a tight little pennant formation here on lighter volume, defined by these lines I had drawn in. So I said, you know, if I get involved, it looks poised if it can break out of this triangle. And if so, a stop would go underneath here. Well, here's what happened. Two things. When we look at it on the shorter term time frame, now we're magnifying and we can see how that triangle, that, you know, pennant actually formed. It never made it out of that triangle. It never made it out. If I had purchased it, let's say right here, my stop, like I said, would have been there. I probably would have raised it quickly personally, because this is what I do, quickly. And then under here, I probably would have been stopped out here. But the point is, if you had gotten involved in this stock, one, you shouldn't have, because the price confirmation wasn't there. We anticipate during the consolidation, we participate once it breaks, and then we manage risk. Well, our first, if we had gotten involved, our risk management was in the initial protective stop. Guess what? Taking stops, making losses, it sucks, but it's part of trading. And your first loss is your best loss. It came back. Oh, hey, look, it's coming back. Oh, no, it's not. Guess what? Prior support acted as resistance here. Just basic technical analysis 101. It's not really complicated. It's us who make it complicated. There's no reason to make it so complicated. So the point here is that regardless of what your time frame is, trend alignment works on every time frame. Risk management, I think I forgot about 8 left. So there's 1. The title is risk management, 7, and it's the most important thing you can do. It's the title on the next slide. Let me read it to you. Risk management. So there's 5 left. 3 forms. There's probably more than 3 forms, but the biggest risk is price. Only price pays. Only price can hurt you. We trade to make money. We don't trade because, hey, there's big volume. That doesn't help you. Time is a risk. Do you want to keep your stock tied up in stagnant stocks waiting to break even? No. So swing trading allows us to leverage time to be in the right stocks at the right time while they're moving, and keep an active portfolio of stocks that are performing well or stopping us out. Leverage is a huge risk and something that's underappreciated by seemingly all market participants of all sizes. Again, Bill Hwang just blew up a $12 billion fund. He was over leveraged, and he lost a personal fortune of over $4 billion in 3 days because he was over leveraged. We leverage our time, we leverage our price. If your stock drops 50%, you need your stock to double to break even. How many stocks have you purchased that have doubled and you held them? I mean, honest assessment. And, you know, I see it happening right now. There are a lot more stocks. We're in an environment where stocks are doubling at a quicker pace than probably I've seen in any environment. And people are getting back to break even, and they're saying, see, buy and hold works. I knew it. Hey, I'm back to break even. And that just reinstills a terrible habit. just manage risk, risk management, risk management, risk management. I think I said it 25 times. I'm done. I'm done saying it, I promise. Plan your trade, and trade according to your plan. Don't get caught up in the emotional aspect. Oh, somebody said this on Twitter. Maybe I'll get out. Oh, maybe so, or on TV or whatever. I try not to look at Twitter during the day because I know my weaknesses. If I see someone saying something, I will get emotional sometimes and go buy a stock. And I'll look at it and go, Brian, you're an idiot. Why did you buy that stock just because of that Twitter post? Why did you buy a stock just because somebody said on CNBC? I haven't had CNBC on in over 9 months. I become emotional. Those are my weaknesses. Those are my demons. Let's cut out the stuff that doesn't work. Where's your protective stop? Where are you going to look to make some profits? Do you have a strategy for locking them in? Does it account for, does your share size account for a fixed dollar amount, the volatility of the stock, the market environment we're in? Just cut your losses quickly, no matter what you're looking at, and try to let your winners run as best you can. Regardless of your strategy, of your time frame, of anything, your job is risk management. Alan Greenspan managed the economy. That was his job. Who has favorite quotes from a Federal Reserve chairman? This is mine. I view my job as risk manager for the economy. I mean, the guy, whether his trades worked or not, he was trying to trade the economy. How freaking cool is that? Almost said bad word. Sorry. Anyways, don't get too hung up on Fibonacci's, volume weighted average price levels, moving averages, any of that stuff. They're only tools, and they're there to guide us, to help us form a picture so that we can hopefully find the best opportunities, which mean low risk, high probability, get involved at the right time, and things do go wrong. Have stops. Use responsible positioning sizing. Be consistent in your approach. So again, just a quick wrap up. I think I've gone over my time frame. I apologize for that. But what we want to do in trend alignment is identify the trade candidate on the bigger time frame. For swing trading, to me, that's the daily time frame. Just look at the 50-day moving average. Is it rising? Innocent until proven guilty. Doesn't mean it's a buy, but it means you can start to look at the shorter term time frames, such as a 65-minute or 30-minute, and say, wait a minute, where does it come from? Is it, if it just did this, and these are days, well, I'm late to the party. I don't want to buy it there. But if it just did this, and let's say these are days, I'm going to anticipate in here. Where does it have the potential to go? Maybe there was a prior peak somewhere around there a year ago. So maybe that's my target. But just try to objectively say, where has it come from? Because that's how much risk you need to take. Where does my stop go? Where does it have the potential to go? That's my theoretical return. It doesn't mean we're going to sell there, but it's good to have an idea just to say, hey, this trade makes sense. So if we're in a stage 2 uptrend on the daily time frame, it looks like this. And then we have stage 2 uptrend in that daily time frame. The intraday could be stage 3. We avoid that. In stage 4, we anticipate in here, and we participate. And repeat that process over and over again. Hopefully we're able to, maybe you're a buy and holder. I'd rather, if it starts pulling back, I'm out, but I'll get back involved here. Starts pulling back, but I'm back involved. So manage risk, stops on everything. Thank you. I'm sorry I went over, but remember, only price pays. That's the most objective thing you can look at. Price has the final say whether you're right or wrong. The market doesn't care about what you think. It doesn't care about what I think. Our job is to listen to the message of the market and manage risk. That's it. Thank you for attending, and I hope this was helpful. Again, if you would like a copy of these slides and that poster, digital poster that is, numeral 1B Shannon, 1B SHANNON at Gmail. Just type slides into the subject line, whatever you want. That'll do it. Thank you again, and best of luck with your trading.
Hey, Brian, that was really a very insightful presentation where I was really picking up tips that I could potentially use in my own trading as well. And I'm sure the summit participants also do now have a better understanding of how to apply your swing trading strategy. Now, to help the participants clarify some of the points that you brought up earlier on, shall we head into the Q&A segment now?
Yeah, absolutely. Let's do it.
Okay, great. So before I go into the specific areas in terms of the presentation that you did on your strategy, I want to just go out slightly into the big picture aspect of it. I want to understand from you, before you get to the point of using your strategy to analyze whether where you should be getting into the stock, I want to touch about how do you even get to the point where this is the stock that I'm going to trade in the first place? Because I mean, considering that you are trading the US stock market, there's based on what I remember, there's at least about 7,000 over instrument stocks on the exchange itself across the different exchanges. How do you even actually filter down that huge list of stock? Do you use things like fundamentals? Do you use things like screening tool to actually screen down to a smaller subset of stocks before you even analyze the trends and potential trading opportunities?
Yeah, great question. It's one that I get a lot. In my answer, I'm going to answer it kind of two ways. One, you've got to realize I've been doing this pretty much every day for the last 30 years. So my approach is one that I've developed over 3 decades. And it's not something that's easily replicated. So my personal process, I'll talk about first, and then what other people can do to kind of, mimic it a little bit. But I have what I call my master universe of stocks, which is about 800-900, kind of bounces around in there. I take some off, put some on, and I look at that every single week. I look at those charts on my screens. I have a weekly chart, a daily, 65, 30-minute, and a 15-minute, and a 2-minute chart. So I look at every single one of those stocks at least once a week on 6 different time frames. And I'm not studying them. I'm not analyzing them so much. You can't. But I'm going through them. It might take me 2 hours, let's say. And I sit there and I make notes, and I'm kind of looking at my from my sheet to kind of show you what it might look like each week. I don't have one here, sorry. Anyway, so I'll get that down to about 200 or so. And those are my focus for the week ahead. And what I'm looking at is I'm not looking for the stocks that are, that broke out, that are up 20% this past week. I mean, what am I going to do with those? Instead, I want to see the stocks that are in uptrends that they've begun little pullbacks, or they pulled back 3 or 4 days, and I want to start to anticipate. So I'm looking at them in an anticipatory mode, and then I take that list and I look at them at the end of every day, and I get them down to a list of about 30 stocks. Those 30 stocks become my focus list. Now, it doesn't mean I'm going to trade them all, because who trades 30 stocks in a day? Not me. I'm looking for swing trades, but I want to familiarize myself with these stocks. So I will say, 2 or 3 become my super focus A-list stocks that I really want to look at, and those will be front and center on my screen each day. And then I might have 5 or 6 that look like maybe something could happen. Maybe if this, if the solar stocks go, maybe this one could. So I'll take those and I'll set an alert on those, because I'm not going to pay. Who can pay attention to that many stocks? So I set a ton of alerts. I don't set alerts that say, the alert goes off and hey, I have to buy that stock. It's truly just an alert that says, okay, something interesting has happened. There's a level that I identified that might be 5 cents ahead of a potential breakout. I don't want to trigger. I don't want the alert to go off when it breaks out, because it might run without me. So if I'm alert, 5 cents, 10 cents before the breakout, depends on the price of the stock too, of course. Then I can look at it on my screens. I can just hit that button, and it populates all 6 of those time frames. Then if I really like it, I'll put it on another one of these charts over here. I've got 9 little windows over here, where those are my focus stocks that I just want to have on my eyes on. And then I'm, of course, managing my positions. So that's how I do it. Now, in order to, and most people will say, well, I can't do that. And of course, but I feel like, I'm listening to the message of the market. I'm not telling the market what I want. So to me, that's a big advantage. I can start to see, hey, I have 3 oil stocks that look interesting, instead of scanning for oil stocks. So, a bottoms up approach. But there are a lot of great scanners out there that you can build very simple things, like the things I talked about. Stocks that are above the 20 and 50-day moving average. Okay, so you've taken, and I did this the other night with Alpha Trend subscribers. We looked at FinViz. There's a free scanner there. They have 8,118 stocks, I think, if I recall correctly, in their database. So I said, it's got to be above its 20-day, 50-day, and 200-day. And that might have gotten it down to about 1,100 stocks. So we got rid of 7,000 right away. Still, 1,100 is a lot. So in average daily volume. So at least 500,000 shares. Boom. Now we're down to 400 or so. Then I look at it and say, okay, so these are all in uptrends. They trade at least 500,000 shares a day. Then I go down and say, what about the optionable stocks? Because those are the bigger names generally. So from 400, now we're down to 350. How about if they have a beta of greater than 1? I want it to be more volatile than the rest of the market. That might knock it down to 225. And then a final thing might be with a short interest of at least 10%. Now I've got that list from 225 down to 180. And if you can look at those 180 stocks and look at them manually and try to anticipate, and you can see the ones that are, super extended. And I don't know if you can do this, filter out the ones that are up 10% in the last month or whatever, and just drill down. It's like a dating app. I don't like people with blonde hair. I don't like people with this or whatever. You're just narrowing your universe into something that makes sense to you personally and your strategy, your time frames.
I see. Fantastic. Thanks for being so detailed in terms of how you actually narrow down the huge list of potential stocks to look at into a much more manageable list before you actually go in to take a look individually on how their charts looks like. So my next question for you, therefore, is let's say you have narrowed down the number of stocks to actually look at them visually to see whether the trading opportunity arises. Now, does things like the trend of the sector or the trend of the broad market like S&P 500 index, does these two sector and the broad market actually affects the way whether you decide whether to trade a specific individual stocks or not? Because typically what I personally notice is that sectors trend, once sectors start to show signs of running, then most of the stocks within the sector will show signs of running together, probably in different magnitude, different speed, but they will all go together. So how do you use sector or even broad market to actually make your decision on the individual stocks itself?
Yeah, that's a really excellent point. And my answer might surprise you a little bit. I do almost no sector analysis. I am, of course, aware we're in a gigantic bull market, so everything just kind of gets the benefit of the doubt right now, if they're in uptrends. Now, as I said, using the example of if I'm looking through my list, I might see, hey, I looked at NOV. I saw, 2 or 3 APA and MRO maybe. There's 3 oil stocks that are getting my attention. Now, and out of curiosity, I might go look at the XLE, and the XLE hasn't moved. The XLE might still be pulling back, but I see these 3 stocks forming that stage 1 and coming up into a stage 2 on the shorter term time frame. We know the XLE is in an uptrend, but it had been pulling back, and now these 3 look to be emerging first. So I get a head start over the sector people, because how much does it take to move that sector? If there's 50, let's just say there's 20 stocks in the XLE. Well, we know XLE is in a major uptrend, but these 3 stocks start moving first. Those are going to be the leaders. Those are the ones I'm most interested in, because they're going to lead that sector. They're going to give the confidence to people to say, okay, now I'm going to go with Devon Energy. Now I'm going to go with this energy because I missed that one and I missed those 3. And I find get a more of a head start. Now, if the market itself is below a declining 20 and 50-day moving average, and I see this and I really like these setups, what I'll do is I'll manage my risk differently in that just position sizing. So instead of taking a full risk unit of X dollars, I'll maybe take half of that risk unit. And I base that on, if the stock is, let's say my risk unit is $1,000 on something that I normally like if everything's lined up. Everything's not lined up. I'll risk $500. So if my stop is $1 away, I can trade 1,000 shares normally, but now I'm only going to do 500 because I'm accounting for the greater risk in the sector or the market or whatever.
Excellent point. Excellent point. I think that's really true as well. I mean, if you have to wait for everything to line up properly, a lot of time you tend to be much later in the move, and you might miss out the biggest part of the move itself. So now, just to further elaborate,
you know what? I'm sorry, I didn't mean to interrupt you. You know how I learned that, of course, is I just got tired of seeing so many stocks run without me. The market would be down, let's say, and I'd identify these stocks and say, well, I'm not going to take it because of the market. And then I sit there and I watch that stock go higher and higher and higher. And, so I said, all right, well, I'm just going to take half a risk unit. And trust me, it's the saner way to do it. As long as you, don't get married to an idea and you keep those stops and all that. So anyway, sorry to interrupt there, Philip.
No worries. So you gave the example of that 3 oil stocks that potentially could be leading the entire oil sector to start the next up run. So then to further elaborate a little bit on that, so you see these 3 main oil stocks that are starting to turn back up. Now, my question to you is, do you just pick one of the 3 to get in, or do you actually divide your trades among the 3 so that you can actually diversify among the 3 rather than just bet on one of it?
Yeah, you got all the great questions here. I tend to focus on one. And, the final determining factor for me is, kind of the personality of the stock. How tight does it trade? If it's one of these ones that's really volatile, big, choppy, bigger range, wide and loose ranges, I'll say, that one looks good, but this one has been in a tighter place, and it comes down to where can I keep the tightest stop? Because if I can, and keep it objectively in a good area, because the tighter the stop, the more shares I can get, the more upside potential I have. So that's how I tend to look at it. Now, it doesn't mean I always choose right. Sometimes I choose the wrong stock, and that one goes down, and the other 2 end up flying, and you feel like a fool. And guess what? That's trading. That's how it goes.
I see. Now, I have another question for you, which is, from my personal experience, is also a dilemma that I usually have. So when you are selecting a stock to get into a trade, do you focus on stocks whose long-term trend has been uptrend for a long time? Or would you consider also looking at stocks that has been hit down very heavily over the past 1 year, 2 years, but is starting to find a long-term accumulation phase? So between these 2 types of stock, a stock that's uptrend has been going on for the longest time, like most of the tech stocks in US, versus some of the stock that has been going in a downtrend for the past 1 to 2 years, and for the past few months, it has gone into a sideways consolidation right at the bottom of the long-term trend. Which one will you actually consider more appropriate for you to look at getting in once the uptrend resumes?
I personally like the ones that are just breaking a longer term accumulation. So I do have, like I said, my weekly chart up, and looking at Casper, it's done nothing for 1.5 years. Looking at VMware, it did nothing for 3 years or so, and is just maybe emerging and starting what could be a mega trend. Who knows? So, whereas NVIDIA, it's been, nonstop up for the last 7 years, 8 years, I don't know, whatever it is. To me, I'll trade those with less size, actually, because I get scared of them, truthfully. I look at it and go, it's way up here. Who's actually buying? Who continues to throw all this money at these things? Don't they know that stocks do go down at some point?
I see. Great point. And that's interesting. And I think that many of the traders out there will probably have to think about this as well, because what I've seen is that most traders are actually choosing or chasing or looking at getting into stocks that are very famous, that has run up a lot over the past 1 year, 2 years, or maybe even over the past 10 years. And there's also this saying that what stays uptrend will likely stay uptrend until it turns. So why don't you just look at swing trading those that has already been in an uptrend? And many people actually fail to realize that there are a lot of stocks that has been hit down really hard are starting to find their footing and starting to turn back up, which could potentially have the fastest and the most aggressive up move thereafter. So thanks for sharing with us your thoughts about that. Now, I would like to move into a more specific questions with regard to the strategy that you mentioned earlier on. All right, so one of the things that you mentioned in terms of the specific entry strategy or the trend analysis is to make sure that it is in a continuation stage, as what you have already mentioned. It has gone past the accumulation. It has started to break out in a continuation stage. So how exactly do you determine a stock is in a continuation stage? Because you mentioned about price, you mentioned about 20 days, 20 days moving average and 50 days moving average. So there is this ambiguity stage where you could see the price breaking above the 20 days moving average. You could see the price breaking above the 50 days moving average. You could see the 20 days moving average crossing back above the 50 days moving average. So these are all different stages at that point. At what point are you able to tell yourself that, okay, we are in an uptrend right now and I'm going to start looking for trading setups?
Well, generally, I want to see, like I said, a flat to rising 20-day moving average, a flat to rising 50. I want the 20 above the 50. I want them both above a 200 ideally. I want them to be stacked as close together as possible, not a lot of distance between the 20 and the 50. And I want to see that maybe that initial surge came on really big volume, just something that, kicked it really hard in the butt. And, it got a lot of eyeballs. And as it begins to pull back, that first pullback is almost always buyable. There's no such thing as always, but I mean, they're almost always buyable as they come back up from there. And then I just want to see if it continues with the pattern of rallying hard on increasing volume peaking, and then it starts to diminish and it pulls back to a key volume weighted average price level, a Fibonacci, a simple moving average, whatever it might be. If there's things in there and it starts to settle down in a low risk way again, and I can manage my risk and buy that first little higher high in the shorter term time frame, that puts me in alignment with what I believe is a fresh, powerful, longer term trend. I want to get involved in those.
I see.
There's less. The closer, and I apologize, the closer you are to that breakout point, if it's truly going to, and you asked me about fundamentals, I like to look at the Market Smith charts and say, hey, earnings estimates are increasing. Look at the revenue growth they've had. I don't know what this company does, but I look at it and I say, CRSR. I looked at it and said, they make gaming devices, that chairs and mice and lighting and headsets and all the stuff that people at home with a stimulus check during pandemic are going to buy to play their Minecraft or whatever they're buying. So I do consider that stuff as well. But it comes down to, the story is a bonus in my mind. It's all about price action.
I see. All right. So in your strategy, you mentioned that when you're looking for the actual setup to enter a trade, you typically look at 30-minute charts and you base your breakout points using that 30-minute charts and the stop loss on that 30-minute chart as well. So then my question for you is that there is always this risk that when you use a very short-term kind of period of a chart like the 30-minute chart and you get into a trade, a stop loss based on that, and you are holding the trade, assuming it didn't hit the stop loss, you're holding the trade beyond days. So there's always this situation that it could get down during specific situations. So is there any specific situations that you avoid getting into a trade, although things look perfectly, like for example, quarterly results announcement is coming up or is going to ex-dividend soon? Does any of these situations stop you from entering a trade that shows you the ideal setup that you're looking for?
Yeah, there's quite a few of those actually. I mean, so like you said, if earnings are due in a day or two, I might day trade it if it's really compelling, but I won't want to hold a stock that I just bought today through earnings that I don't know anything about. There's too much event risk based around that. I don't like to initiate new swing trades the day of a Federal Reserve meeting. I don't like trading commodity-based stocks. I mentioned oil, which is funny. I don't really like trading oil stocks. I consider airlines to be kind of a commodity because you've got so many variables with airlines. You've got viruses, you've got supply and demand of oil, you've got all kinds of things that go on. I don't like to trade, commodity. So gold stocks, their personality. I just lost money on the last one I traded. And I always tell myself, I hate gold stocks. I'm not going to trade them. The setup was so good. I bought it. held it like 3 days, then I gapped down, doing my stop, and I said, why, why?
I see, I see. All right, so do you use time stop in any way in terms of a strategy? Let's say after you got into a trade, it didn't hit your stop loss, but it just keeps on hovering around that level between your entry and your stop loss level. Do you in any way use a time stop because you don't want to waste time anymore and there are better opportunities coming up? Do you do time stop in any way?
Yeah, I don't use a fixed time stop. Like I don't have a deadline if it doesn't move within this period of time or whatever. It kind of depends on the market. If the market's ramping higher and this stock's just sitting there doing nothing and I've got other stocks to pay attention to, I might just like, it's just not ready yet. I'll revisit it. But it's probably more to do with boredom in the stock and that it's not doing what I anticipated. And I have other positions that take my attention. So it kind of, if it, relative to my other positions, if it's not doing anything, doesn't seem like it's going to, I'll just boot it, set a new alert, and maybe revisit it.
I see, I see. Fantastic. Now, I would like to move on to some questions about VWAP itself. So VWAP, just now you were mentioning that it actually, from the way I look at it and from the way you actually share with us about it, it seems to be some kind of a moving average, a shorter term moving average in a way, right? Just that it takes into consideration the volume as well. So it seems to me that based on your presentation, you are potentially using VWAP as a place where you look at where it breaks out above the VWAP or breaks down below the VWAP, right? So how do you actually use that together with the moving average and your price action breakout? Is it a form of, is VWAP a form of a confluence factor to your price action analysis, or is it a trade setup precision kind of tool that you use?
It's kind of a confluence and a confirmation. So like I said, I like that 5-day moving average to flatten out. It makes a higher high. And I want to see that volume weighted average price from the prior swing high is starting to, flatten out. And it tells me the buyers are able, it looks like they'll be able to definitively, mathematically, dollar cost average confirm that they are in fact in control based on the absolute dollar amount. It's the absolute truth. A time-based moving average is, based on, 20 days. Who came up with that one? Why? Why 20 days? Why 50 days? Why, if we're going to use a 50-day moving average, shouldn't we use a 63-day moving average because there's 63 business days in a quarter and earnings are reported once a quarter? It's represented as a moving average. It moves as each average, as new information is built in. And, the trick with a VWAP is where do you anchor it from? Where do you begin that measurement? So again, a swing high, a swing low, when they converge together and create that pinch, it says the energy is converging. The buyers in the bigger picture are still in control. This looks like a pullback. If it gets back up through there, well, then everyone who's shorted on average is losing money. They're going to regret that. The average long who's been averaging into this is now winning. They're going to be more confident. There's going to be less, the scared money has left the stock on the pullback, and now it's in a position that's just much more likely it will continue in the direction of the original trend.
I see, I see. So in the scenario where the price actually breaks above the VWAP, but hasn't break above that price action resistance that you're looking for, will you actually get into the trade already, or will you wait also for the price action breakout to also happen before you get in?
I generally wait. Now, if the market is really trending strong and I see stocks in that same sector are running, I'll sometimes do a cheat entry and say I'm going to get in front of that because the variable of this sector of the market, something not quantifiable specific to this chart, is telling me there's greater likelihood it'll continue. I'll preempt that breakout and get involved. And sometimes I'll try to break the stock out myself if it's a little one.
Okay, great, interesting. And I believe that there's going to be a question on many of the summit participants' mind is that, okay, so for this VWAP tool, it looks like it's very interesting and is it readily available on most of the tools out there? Is it free of charge or something that needs to be paid? How do you get that, for example, using TradingView, which most people use? Is it readily available to use this VWAP overlay?
Yeah, TradingView has a great iteration of it. They have it built in. It's one of their standard tools. On the left side, I think if you click down, like it's the second thing on, second tool down on the left, and you open that up, it'll say anchored VWAP. And, they've got it perfectly where you can just click on the candle you want. You can drag it around. It's on TrendSpider. Those guys are friends of mine. They've done a great job of it. As I mentioned, it's on Ninja Trader. It's on Yahoo Finance for free. There are, I've seen, a lot of people use Thinkorswim, and some people have written codes, whatever they call them over there. They've written codes so that you can do it there. The problem with that is that you have to input, okay, June 4th at 12:36 p.m. You have to type that in versus just point and click. And believe me, it slows it down. It's really a pain in the neck to have to do that.
Fantastic. Thanks for sharing about the tips on where to actually get V1, which tool might be, which platform might be easier to use. Yes.
On Twitter, on my Twitter, my pinned tweet, I have a little article about how to use it. And at the bottom of that article, there are about 8 data providers that I have listed with links to them of where to find the anchored VWAP.
Fantastic. All right. So Summit participants, please take note of this. Otherwise, when you're asking for the slides from Brandon, just ask as well, where is the link to that Twitter post that they can actually take reference from. All right. So Brandon, Brian, I want to just get a little bit about your insights of the execution way, the execution workflow that you do. So you mentioned that typically you wait for the breakout to enter a trade. So do you actually set all these orders into the system and just let the system execute the trade when that breakout happens at that point in time? Or do you actually manually wait to see the breakout happening on an intraday basis before you actually manually execute the trade?
Believe it or not, Philip, I have never once set a buy stop order. I have never done it. I think that, first of all, if you're going to set those stops, you're setting them before the market opens, and you're going to get caught up in all kinds of shenanigans that go on the open, and I'm giving up control. And, there's not a lot we can control in the market. So to give up that aspect of, okay, I'm going to let the market do it for me, I don't have the confidence in the market to do that. Again, especially first thing in the morning. Sometimes I regret it, because I won't have my eyes focused on that one stock. I'll see an alert, but I'm busy with something else. So I ignore that alert for a minute, focus on what I'm focusing. I go back to the alert and go, holy crap, look at that one. Man, so you're just going to miss some. That's my personal, investing, trading, it's so personal. You've got to figure out what works for you and realize that nothing's going to work all the time. So you have to accept that there's going to be mistakes. There's going to be regrets. If you can minimize those and, not have FOMO when you see it and say, well, I'm going to buy it now, even though it's up 10%. You just say, you know what? It went without me. Fine. I'm good at picking stocks. I can find another one. I'm in no hurry. The market is there. The process is repeatable. And just have faith in whatever strategy it is that you use that you've determined gives you that edge. Trade it on your terms. Don't give up control is what I think.
I see. Fantastic advice on that. So I also wanted to ask you, were there situations where initially it seems like the market was very conducive, you see many of the stocks that's under your watch list all breaking out and trying to move higher at the same time? Were you ever tempted to actually get into multiple positions within the same day or within the same few days? Did such kind of situations happen before?
Yeah, I do that all the time. Okay. I'll enter multiple trades on a day. I mean, I don't have a problem with that, especially if I'm underexposed coming in and I see things developing. I've conditioned myself to put risk on really quickly if I see things developing. But I will do it also very discriminatorily, meaning I'm not going to chase things, but if I recognize the opportunity is there quickly, I'm gonna jump all over it. I'm not gonna delay.
I see, I see. And on that note, if you actually enter multiple positions very quickly, one after another, do you also encounter situations after that where all the trades all failed within a 1 or 2 days period at the same time? That means you could potentially experience consecutive multiple stops being hit within a very short period of time. Have you experienced that before, and how do you handle that psychologically?
I drink heavily. It sucks, it sucks when that happens. And anyone who says it doesn't happen to you or hasn't happened, I'm not sure I would believe them. But, it's just part of trading. And you have to look at it and say, did I make an error here? Number one, should I be mad at myself for what happened here? Because eventually it all comes back to me and the decisions that I made. Did I make a real egregious decision here that, I should be beating myself up? Or, the Fed came out in the middle of the day and said something that was unexpected by everyone. They said they're going to stop doing this or going to stop their accommodative stance. When that happens, we're going to see a flush. Everyone's going to get hit hard, quick and hard, and there won't be time to react. It's part of trading,
And if that's the case, how do you handle the rest of the potential ideas coming up right after that? Do you still just continue to trade as per normal, or do you actually start to hold back for a while? Because something that some situations I personally notice is that when I get into like multiple trades, one after another, and all of them get hit at the same time, that usually means that the broad market is starting to see some kind of significant correction. And maybe over the next 1 week or 2 weeks, the broad market is still going to see further correction. So if during that situation and you see some individual stops breaking out, do you still continue to just take them and as though that the broad market is not actually in a downtrend mode? How do you handle that? Or do you just continue to wait a little while more for things to actually quieten down a bit before you start looking at entering trades again?
Depends on how hard I get hit, but if I get hit real hard, then I'll just say, you know what, just go take a walk, get away from it for a little while. If it wasn't so bad and I, see things that, maybe that was an aberration in the market, I might start getting back into some things, but, smaller size again, less risk, half risk unit, third risk unit, just try to get back in and get my confidence back and make sure that, it wasn't a stupid thing that I did. It was some unforeseen event in the market that I had no control over.
I see. Fantastic. All right. So, Brian, just as a summarize and a conclusion to our session today, would you have, let's say, 2 or 3 very important guidelines or suggestions for the summit participants who are looking to implement the kind of strategy that you have just shared in this presentation? What are some 2 or 3 of the most important aspect that you will want them to be very, very aware of when trying to adopt the strategy that you have just shared in this presentation?
Okay, that's easy. What did I think? I think I said 50 times. Is that how many times I said risk management? It truly is job number 1. If you can't control your losers, you won't be in this business very long. So 1, seriously, just cut your losses at a place that makes sense on the chart. Not some random percent. A random percent is better than nothing, but better than that is use the definition of trend for the time frame you're involved in. Place your stops and longs underneath the most recent relevant high or low. For shorts, just above the most recent relevant low or high. Let the market take care of that. Second, for swing trading, I cannot tell you how much money it has saved me to not buy stocks where the 5-day moving average is declining, or to short stocks where it's advancing. It has saved me so much money. It's just really, in my mind, the most powerful swing trade tool you can find. Third, learn the volume weighted average price. Learn where to anchor it, the correct anchor spots. It's an art. It takes time. It can be frustrating, but you'll be fascinated to see how often, and it blows my mind constantly, how often there will be, I'll put a volume weighted average price anchored to a recent low. The market will pull back 2.5%, touch that within, 5-10 cents on the SPY. and then just turn right back higher, $3 instantly. It happened last Friday. It was crazy.
Right,
So
fantastic.
risk management, 5-day moving average, and learn the volume weighted average price.
Fantastic, fantastic. Now, Brian, this has been a really fruitful session for me, and I'm sure the summit participants benefited greatly from your sharing as well. So thanks again so much for your participation in the summit.
Phil, thanks for putting it on. I'm looking forward to seeing some of the other speakers as well. You've got a great roster here, and I'm getting tired too. Anyways, thanks again for putting it on, and best success to you and everyone else involved listening.
Thank you. Now, for those of you watching this summit video right now, if you would like to keep in touch with Brian and remember, receive a copy of the excellent presentation slides that he has put up and presented earlier on, remember to send an email to 1bshannon@gmail.com with the subject title slides, or better still, Trading World Summit slides, and it will be easier for him to know which slides to send you. And we will be putting his that email address in the description below this video. All right. And finally, if you would like to review Brian's summit video beyond the summit, or to watch more of Brian's recording from our previous summit, you can also check out our TraderWave TV service, which is in short, the Netflix for trading education. Now, with that, we have come to the end of this presentation and Q&A. I'm your summit host, Philip Teo, and I hope you will continue to learn and apply the teachings from the many wonderful speakers on board this virtual summit. Take care, and we talk soon.